Hey, yeah, what? Grab your bootstraps, yeah, let's scale your growth. Here's the truth, Jack. We'll reach the globe, unveil the notes.
What the fuck?
Earn your digits, won't burn, you'll get it. See, this is factual. Funds will show, learn to flow with Candid Capital.
This is a Candid Capital interview. In these episodes, we host industry business professionals involved in the global tech ecosystem to discuss various topics related to tech, global economy, and building sustainable businesses and investments. So welcome to the Candid Market Update segment, a live stream hour covering top of mind topics and anything relating to the innovation economy. We have guests here from different ecosystems to bring a few interesting articles or topics from the week that they've read to discuss, and different deals that they've been involved in or that they've seen and they would like to highlight. This week we have partner and investment director Martin Cheski from TELUS Global Ventures. Thanks for coming, Martin.
Thanks for having me, Josh. I'm happy to be here. Happy to see you again.
Yeah, so usually like how I just like to get it started is for the audience is just to learn a little bit about what is the firm you work for? What is TELUS Global Ventures?
Great. So TELUS Global Ventures invests across 5 main thematic areas. We're really software focused. We find it integrates better with our ecosystem and expertise as a digital services company. And also we find it scales better and faster across some markets and geographies. And we also like the margin profile of software. Those 5 thematic areas are digital health. So think about patient journey optimization, EMR, electronic medical record data operability and insights, virtual care platforms, and aging in place. We also look at ag tech. So think in this space, precision and predictive agriculture, consumer data platforms, consumer goods, supply chain management, smart retail execution. We invest in B2B SaaS and IoT. Think there about smart cities and buildings, video analytics, energy management, and objects in motion like cars, bicycles, people, transportation systems. The 4th area is connecting consumers. So here, think about AI and digital enablement services that automate and enhance the business side of the consumer relationship, but also deliver omni-channel and highly personalized consumer products and services. And the last is impact. So here, think climate resilience, carbon capture, carbon verification, women's issues, aging and longevity, including both communities as well as the residents that live there.
So, and what markets do you invest in worldwide?
Yeah, we're global in nature. We're a growth investor, so we target Series A and later. It's an area that we feel we can best leverage the scale of our parent company and single LP TELUS to accelerate the growth. We're really thesis driven. We've got sector and geographic leads that work both, inside out with our corporate business partners, as well as outside in, and help them inform some of their Horizon 3 strategies. Typically, our check size is somewhere between 5 and 25 million USD. We'll take around 5 to 15% equity in a company, and we'll traditionally take a board seat. We find that, being a collaborative investor, it helps us look at product market fit, channel execution, etc. We've got about 80 companies in the portfolio now, spread across all of the major world tech centers. We've got 20 team members that support that. Again, mostly based in North America, but also some located globally. And we've got a relatively high cadence in terms of our capital deployment. So in 2023, we did about 30 transactions with about 17 new portfolio companies joining. And this year at the end of Q3, we've done 20 transactions with 7 new portfolio companies joining. So, we don't necessarily see the last couple of years necessarily as a down market for us.
Okay. Well, like, given that you're a global firm, you must have some thoughts on trends and where you see the market going, for venture and innovation ecosystems in general globally.
Yeah, for sure. So, I and we at TGV were generally bullish, right, on the VC market and landscape. And I think that investing in VC, you really have to be, searching for those opportunities and be optimistic about the market. We've seen a real rush to quality over the last 24 months, just based on some of the down cycles in the VC market. It's been depressing some valuations, but now we're starting to see those slightly reverse. Previously, we kind of, I use the analogy, right? Common analogy, the rising tide lifts all boats. And I think that was the case in the latter part of, 2020, 2021. Now we're seeing a little bit of a low tide. And so you've got to pick your entry points. And that's why we're seeing kind of a rush to quality. But we're seeing lots of, really positive leading indicators. So if we look at the earlier stage, which we do track before we do those later stage investments, on the pre-seed and seed, that still remains strong. While the valuations are off a little bit, there's still good deal cadence there. Prashant Mehta at Panache Ventures, which is a leading Canadian pre-seed and seed investor, he recently penned an article on BetaKit where he pegged a market bottom. He's seeing, high levels of startup formation activity, declining cost of capital, improving macro and liquidity conditions. He's seeing accelerating technical advancements in the areas that he's targeting. And he's also seeing, a number of founders moving into the space. And so there's a lot of excitement from him.
So do you think that we already hit the bottom and we've kind of passed that, or, just in terms of venture?
Yeah, I do think it's bottomed out. JP Morgan just recently released some data that the top quartile valuations, are trending more towards pre-pandemic stages. There's still some uncertainty in the marketplaces, but that's a positive leading indicator. And Carta just yesterday published some Q3 data showing that the round sizes were, while they're a little bit more volatile at the seed, Series A through to Series C, the overall picture seems like it's improving in terms of valuations and activity. Of course, we're seeing some high spots in things like AI. So there's always pockets of continued high valuations. But, generally across the market, I think we've seen a little bit of a malaise over the last 24 months. I believe that's starting to really turn around. There's, of course, going to be a couple catalytic events, right? The US elections coming up in 4 weeks, as well as the decisions on the Fed through the balance of the year on interest rates. So I'd encourage everyone to continue to look at those macroeconomic indicators as leaders into the resurgence of the IPO market, which will increase liquidity for the VC community, and really kind of do a push and pull on valuations through the VC value chain.
So I guess two questions. So the first one, it seems AI is kind of keeping VC going, at least in the last couple of years. Do you think there's space for anything else, or is just everything for now on is going to have some sort of AI spin to it?
No, I think we're seeing pockets there, and even within AI, it is not all the same. So you've got some very dominant players at the infrastructure level, at the top of the stack, at the application layer. We're seeing lots of new companies, which may roll over the next 24, 36 months as new models are developed, new business models are deployed in markets. I think there's lots of opportunity out there. You just need to seek quality in terms of founders, your co-investors, and be knowledgeable about the segments that you're looking at. For example, we've had some very positive momentum in our digital health side on the customer journey. And so coming out of COVID, or even during COVID, we know that the healthcare journey was under strain, right? And so coming out of that, we've got to be more efficient, more effective, put a little bit of power back in the hands of the patient to control that journey. And so, we've invested in a couple of companies that are helping patients navigate through the very complex healthcare system in a more effective, more efficient way. It does a couple of things, right? It helps the patient in terms of their eventual outcomes on their healthcare, but it also supports the system and the resources, the strained resources that are there, and helps drive efficiency through that. So we look at those as pockets of opportunity outside of while they are AI adjacent, right? There's pockets of opportunity everywhere.
So you mentioned the election and that's coming up here, and that you think that we're heading potentially to the IPO market coming back. So do you think it's that closely correlated? Like, are you expecting 2025 that the IPO market you think will come back, or do you still think it's a few years out?
Well, I think my crystal ball is still a little bit cloudy on that one. I was of the mind that it would come back in 2024. That is yet to manifest itself. I don't know if it's exactly correlated to the presidential election or cut rate in the Fed. I think what's happening now is there's a period of uncertainty, which creates volatility. And so the election will create certainty in one direction or another, right? Republican, Democrats. And so I think just providing the market with some sense of surety in terms of a path, one way or the other, will help stabilize what's been a fairly volatile market over the last 12, 18 months.
So given that you guys operate in multiple regions, are you seeing anything, I guess, very obviously different than the Canadian one in terms of market trends for their innovation ecosystems? For example, here, we travel some of the same circles, but also some different, and it does seem to be a little bit more pessimistic here on venture, unless you just raised your fund and you got some money to allocate. But from talking to different groups raising funding, or even startups trying to get Canadian funding, it seems to be a little bit less optimistic. So if you had any color you could add to that in relation to what you're seeing in other markets.
Yeah, I was at the Ontario Genomics conference earlier in the week, and a very similar question came out of the audience with respect to that. Their question was, do we think that the Canadian market is more risk averse than the US or other global markets? I think there's a number of dynamics in play there. I think the Canadian market is just smaller, on a relative basis than the US and aggregate European market. I think the tax and economic structure is a little bit different here. I think the Canadian market benefits from some of the programs out there, the government programs, some of the incentive funding, as well as the strength of our major banks also supports the Canadian ecosystem very well. I'd say that Canada, though, is probably a little bit of a laggard in terms of, the US market. We're starting to see some of that rebound within San Francisco. That'll likely percolate over to, in a general way, into the New York, Boston markets. And then I think it'll come over to Canada. I think some of the structures in the US, look, it's just a vastly different market there. Huge market, lots of capital. I know that you were talking about dry powder on a previous podcast. There's lots of dry powder out there, primarily focused in the US markets. So I think that Canada is poised for a rebound. I think it's got a very strong technology ecosystem and early stage startup ecosystem. So I think the rebound will come fast and furious. But still, it's a ways away. If we look at the European market that we're also invested in, its priorities have shifted somewhat in terms of focusing on the energy market, and making sure that they have domestic sovereignty over some of their energy policies there. And so things like renewables, energy management are a little bit more popular investment themes in Europe at this time. So I think again, back to my earlier point, there are pockets in each one of the geographies, in each one of the sectors that I think are doing, really well. I think there's some that are poised for a rebound in the near term. You just have to kind of seek those out.
Yeah, so that kind of leads me to, maybe I guess you could call it advice potentially, but there was, I'd say, probably 2 years ago, an explosion, I would call it, of emerging fund managers. Just people from all different parts of the country and also different backgrounds trying to raise funds. So, do you think this is the time to be pursuing that? Given specifically to the Canadian market, I'd say.
Yeah.
Um, do you have any thoughts on that, or what you would tell an emerging fund manager who's either struggling, thinking to roll it up, or someone who's thinking, "Hey, I'd like to get into this"?
I think that existing fund managers are having a challenge raising and deploying funds. I think it's more, the deployment first will then drive the raising. So I think we've got to clear some of that dry powder. I think we've got to have some liquidity events that'll enable recycling of capital. I think Carta put out some data a couple of months back that said the 2021 cohort of fund managers, it's the longest deployment cycle in VC recorded history, which admittedly goes back, probably only 20 years. But they're deploying now capital over 3 to 4 to 5 years versus kind of a traditional 2 to 3 year cycle. Lots of factors that we've already gone over that are kind of playing into that. Simply supply demand equation is probably top of mind there. I think there's an opportunity. I think, look, if you've got a quality insight, a quality area of the market that you can focus on, I don't think there's a bad time to start raising a new capital fund. I think that, maybe 24, 36 months ago, it was a little bit more of an open checkbook. And so you didn't necessarily need to be the number one or number two in the marketplace to get funding. Now, I think with this rush to quality, it's really important. So make sure if you're a new fund manager that you have a very specific value prop, you've got knowledgeable expertise in the area that you're probably going to focus on, and that you've got key partners to join you on the journey. I think it might be a challenge for a generalist fund now to raise dollars, but if you're looking at specific topic areas, I don't think there's a bad time to ever start that journey.
Nice. So, and you mentioned quality there. So this takes me to one of my favorite side topics, which is EBITDA. Myself and I'd say some other VCs don't think looking for EBITDA or expecting it out of a startup is really a venture capitalist pathway. But I was wondering what your thoughts are on it, as you're on the venture side of TELUS, but TELUS is also a little bit in the corporate venture category as well. So how do you guys look at EBITDA, or think about kind of this narrative of a lot of different kinds of VCs that have been on stage suggesting that companies need to be looking at that, which has traditionally been a PE kind of mandate?
Yeah, I guess it is a little bit more late stage focus. So for us, being corporate venture capital, we are seeking revenue generating companies that have a path to profitability. That's within our mandate. We do work hand in glove with our M&A team, which will acquire companies that are probably for the most part EBITDA accretive to the TELUS P&L. We also need to manage some of our, we are a public company that we roll into where we invest off the TELUS balance sheet. And so we definitely need to keep in mind ownership percentage. And as that increases, the impact of equity consolidation on our parent co's P&L. And so we're very focused on where the company is in terms of its revenue profile, its EBITDA profile, its net income profile as it moves through the growth journey. We again, so in summary, we don't believe that a company needs to be EBITDA positive to be investable. However, it does need a path to profitability and a defined time frame for that, but that could be extended, right? That could be 3 years, that could be 4 or 5 years away. We want to make sure that we're tracking milestones though along the way, right? So where are you getting? Where's your cash burn? Where's your cash burn versus expected? What we saw over the last 24 months is there was a lot of companies that raised capital right before a little bit of the dip, and they were cash flush and didn't necessarily adjust their cash burn. And now when they're coming back to the market to raise funds, there's a little bit of reluctance in the market to support those companies that have yet to hit some of those major milestones, but burn through some of the cash. And those are the ones that are challenged. The ones that are being very successful have managed their cash burn reflective with the overall market, right? And they're still, in most cases, we might have supported them with a small bridge round, but in a lot of cases, they were able to support their product development and growth through the cycle without having to raise over the last 12 to 18 months, which for a lot of companies has been really problematic. So, I think some of the cream is kind of rising to the top in the operating companies, but we're also, we're not we're not in the business to put companies out of business. We're there to support them. And so we've helped companies along with that journey through our board seats and through our product development side. We engage with companies on proof of concepts. At TELUS, we've got 70 million lives covered under our healthcare programs. We've got 500 agriculture companies as customers across 5 different continents. We've got 650 global brands managed under their consumer journey, and we've got 19 million customer connections on our kind of core telecom infrastructure. So we've got a fairly large base to draw from when we're trying to help these companies kind of navigate their growth curve.
I think this is a good time to segue into our second topic, which is, corporate venture. And so, this might be this would be insightful to kind of see like how a corporate venture entity kind of views investment and kind of the strategy along it. Because as you mentioned, it just sort of the EBITDA and kind of what you're looking for might be a bit different than a traditional VC fund.
Yeah, I thought it might be a good topic. Probably corporate venture capital doesn't get as much exposure. Recently, Global Corporate Venturing, which is a kind of an industry body that a number of us subscribe to, they released a study that said that there are now over 400 corporate venture capital arms globally, which is up, significantly, like twofold over the past number of years. At TELUS Global Ventures, our mandate, we're the strategic investment arm on the minority ownership side. We're there to drive primarily scale within TELUS lines of business, and that's either through new markets, new geographies, or even our existing roadmap acceleration. We're really the kind of one of the key enablers in turning TELUS into a global products and services company. In Canada, TELUS is probably best known for its telco products and services, but elsewhere in the world, it's a major provider of digital healthcare, ag tech services, as well as leveraging AI across, again, that customer value chain.
What is Talis doing in ag tech? I would never have thought of that. Like as
Yeah,
a Canadian, I wouldn't even be thinking of Talis in that. I only know telecom and healthcare. So I'm just kind of curious as to, just at a high level, what are you doing there across the world?
yeah, we do everything right from seed in the ground all the way to consumer packaged goods and evaluation of marketing programs in grocery and retail stores. We're focused on the digital side primarily, so that value chain that connects all of those particular areas. We're invested in things like robotic solutions for autonomous farm vehicles for harvesting, planting, etc. We're involved in drone applications for crop monitoring, for spraying fertilizer. We're involved in supply chain. If you look at food provenance, if you look at your organics on the shelf, if they're coming from overseas, right, where they may have different regulations, you want to make sure that both from a consumer perspective as well as a food producer input perspective, that you're actually buying the thing that you think that you're buying and probably paying a premium for. And so tracking that particular product through its journey into your facility is important for us. So supply chain management. And then at the very tail end, it's things like shelf space analytics, it's video analytics in the grocery stores. It is things like scraping the web for interesting ingredients and recipes that may come from TikTok or somewhere else, and you can see kind of different influences, different geographies, and so we're invested in a company that scrapes a lot of that data and tries to play it back to the food and beverage industry, which spends multi-billion-dollar a year on their R&D programs, and tries to give them real-time, real-world insights on where some of the tastes and preferences in specific markets are moving.
Interesting. So do you see corporate venture, kind of on the rise? Do you think it's going to continue to get bigger? I believe in the past, at least in the beginning of this, the 2000s, corporate venture kind of went like this, and then like that, and then like this. Do you think you think it's been figured out? You think it's just going to continue to grow? In a lot of different countries. I know when I go to Europe, it seems like that's a lot of the venture happening over there seems to be corporate venture. Do you
Yeah, I
sense
think there's definitely going to be peaks and valleys on it, but I think the overall trend is up and to the right. If you look at things like sector expertise, right, that's something that a strategic investor, corporate investor can kind of bring to a startup in terms of their product market fit, in terms of their go-to-market expertise. So again, just back to TELUS, when you're talking about agriculture and we've got over 50 countries covered and kind of 5,000 customers, like we're a very good proof of concept, right? If your solution works with us, it's probably going to be an industry-wide solution. So, I think from that perspective, it can help. I think the rapid evolution of technology just drives the interest in corporate venture capital. It's hard for our internal teams to keep up with the developments within our own business, let alone in some of the adjacencies and new markets. And so that's where investing in startups that are aligned to our main product thesis areas, contributes to benefit for corporate capital. I think we've got a long-term perspective too. So we don't, at TGV, we don't have a specific fund expiration date. We don't need to necessarily return capital at the end of the typical 7 or 10 year life cycle of a VC. So we can kind of stick with that company through its growth curve, which is pretty interesting for them. And then again, we can just marshal a ton of resources behind it. But I think, one of the more important points and something that we try and focus on is it's not just TGV as your strategic partner, or it's not just us as an investor. We try and curate specific consortiums of investors together that hit on all the areas that the company needs. So we know that we can't fulfill, even though we've got, experts in product market fit, experts in go to market in their specific sector. We can't fulfill all the needs of the company. And so bringing others on board, whether that be in some of the later stages companies that we're invested in, maybe that's a PE firm. In some of the earlier stage companies that we're invested in, maybe that's an HR professional, or someone that can augment their corporate structure, right? I think all of those investors are important. We're trying to create a curated collaborative board as we join the company. And I think that pays dividends both for the investor as well as the founder and the company and its growth.
Now, I'm not saying this is Talus's corporate venture strategy, but some of the things I've seen from other large, or at least I would say it's a correlation, maybe, is the corporate ventures supplementing internal R&D or innovation. Some of these larger corporations have cut back on their sort of internal development, and it looks sort of like a buy versus build strategy, or both. And if I were to guess, it seems like that's one thing driving it. What are your thoughts on that?
Yeah, I think it's an augment for sure. So we work very tightly with our business unit partners to understand their strategy on a go-forward basis. But we also, with our Horizon 3 experiences, as I talked to kind of off the top, we also help them inform their strategy so they can kind of see where the ball is going. And then, so we have very frequent touch points with our business unit partners. We also include our M&A team in that. And so we're very specific on when we're rolling out into a new market space or a new geography, exactly what we're going to build, exactly what we're going to buy to potentially augment that sector, and exactly what we're going to use venture for. And so it's a very deliberate strategy on our part as we deploy some of those major solutions. Some other corporate venture capital are maybe at a different stage of their evolution. Maybe they're just using corporate venture capital to augment their internal operations. And definitely TELUS did that on the early years. If you think about our telco environment, we invested in companies that would help optimize our domestic telco environment. However, we're kind of seeing it now as a multi-pronged approach where we can both get those internal efficiencies. We can also create new products and services that we can then resell to others as we try and roll out and we can expand into new geographies as well. I've got a couple of examples at the end that we can go through that demonstrate those, but we'll just park those for now.
Yeah, I mean, I kind of want to switch it to the sort of the startup's perspective or the founder perspective. And so, what do you think the engagement is that's different, or that you would recommend founders do with a corporate venture entity versus a typical VC in trying to get investment or from TELUS or somebody else that's in corporate venture?
Yeah, I think from a founder perspective, there's always a dynamic there. They're always moving quickly. They're always pivoting into different areas to determine that product market fit. There's a recognition that corporate venture capital, the venture capital side moves fairly quickly. our large organization with 80,000 employees across the globe moves at a slightly different pace sometimes than our founders. And so that creates a sense of friction at some points. I think it's also an opportunity. What we can share with them is we've been on the journey of growth. And so we know what step 2, step 3, step 4 looks like. An example, because we deal with customer data, especially healthcare data, our privacy and security policies are, top notch. We've been the recipients of numerous awards with respect to our privacy and security. Those are lessons that, we'd rather impart on the founders at an earlier stage so that they don't have to go through something like a breach or a loss in confidence due to, exposure of their data. And so the benefit that we bring to them is from farther along on the maturity curve. Here's kind of what you will end up looking like when you actually achieve unicorn status. And so how can you go from A to B, I think is how we help them on the journey.
I think this is the right time to talk about a couple that have you guys as a partner in their journey. And so, we can move on to kind of some of the companies that are in your portfolio. I think you had a few that you could highlight for us.
Yeah, there's a couple off the top. I guess off the top, it's FirstVet. So TGV led their $20 million Euro Series C. They're a Stockholm-based company. They're a global leader in online pet health and pet services. And TELUS has recently launched its own My Pet solution. FirstVet isn't in the US market, in the North American market at this point. We invested in them recognizing top-notch technology. The US market is valued at about $400 billion for pet care and pet services sales. So it's ripe for mass acceleration of a world leader. And so we're partnering with them. We've got a commercial agreement. We've done an investment in them. We're enabling their entry into the US market, but also being able to work with them to build capabilities within our domestic My Pet product that will make it more robust, create a really solid competitive moat. So I think there's advantages there that we're providing both from a scale and scope perspective, but also on a product hardening side.
That's interesting. Pet care is definitely, or pet services is definitely not something I normally associate with TELUS.
We launched it as part of the learnings from COVID, right, where we had a lot of virtual care. And there's a lot of virtual care, healthcare platforms out there. Those, number one, they dramatically increase access to services for people. If you think about Canada's geography, right, remote communities benefit materially from access to these virtual healthcare services. And so we've got a very robust platform for people health. And so it's a natural evolution now. 65, I think, percent of the population of North America has at least one pet. Again, it's a $400 billion industry in the US. It's a natural evolution for us to take something that is highly effective in the people space and move it into the pet space. And so, that's kind of how TELUS is moving into those adjacent markets under the same kind of thesis area.
Yeah, I know that makes sense. If there's one thing COVID did, it did create an explosion of new pet owners, for sure.
Yeah.
And what you said, you had a couple companies. Was there another one?
Yeah, we've got another one, Kode Labs, which is a Detroit-based startup. They did a $30 million Series B earlier this year. It's a smart building platform, effectively creating a single pane of glass across all of the, HVAC, security, building management systems. Includes things like IoT, if you've got that. Anyways, it creates a single pane of glass. Buildings nowadays account for 39% of global carbon emissions. Even if you look at the rise of AI and the energy consumption of those mass data centers, if you look at the leverage that we can bring to Kode Labs by selling in not only into TELUS is a fairly substantial real estate portfolio, right, on its own with respect to its office buildings, its data centers, its network operation centers, and then those little specific cell site, cell tower real estate. So we can benefit from their single pane of glass in our own environment, but we can also co-sell it with some of our other major customers, government customers, major Canadian and US operations that are customers of our traditional telco services. We can sell them into those solutions as well. And then lastly, there's large real estate players, CBRE and others that manage fairly vast portfolios of real estate. And they're, as they're consolidating those operations, they're looking to also increase efficiency, not only at the building level, but also at the operations level. So think about now they run their own operations centers where they can now manage in a single pane of glass multiple buildings within an urban area from a single desktop. Like, that's a lot more efficient than having someone have to sit in the building and manage all those systems independently. So we think that that's a real area for growth and a really interesting opportunity for us to collaborate, leverage, and use their solution.
Yeah, no, the construction tech area is, kind of when I put my futurist hat on, I guess you could say I find it very interesting. And there's a few, I guess, pathways that I kind of like, or at least it's one potential future. And if we're looking at the West, in our demographics, aging population, high cost of labor, I can see a lot of the way buildings start to look and how they, I guess, interact with themselves changing over time.
Yeah.
If we just take the labor example, we started building buildings inside of warehouses like 2 decades ago, before shipping them out to the sites, because you cannot rely on hiring 50 guys to do it on site. Yes, there's cost implications, but if you take that and you add it with some of the 3D printing projects that they have out there, it's one potential pathway to solve some of our labor shortages for construction. The downside is our buildings probably won't be pretty. So there's this just an interesting, I guess, future outlook that some of these construction tech groups are offering.
Yep, 100%.
And so we can, if there's a deal that you'd like to highlight from the week, or some upcoming companies that are on your radar that are doing something interesting that you'd like to mention.
Yeah, I think that the last couple of companies there, FirstVet and Kode Labs, were really kind of Horizon 1, Horizon 2, which people can probably see immediate application of those. And yeah, I've tried to help people understand how they can fit into the current TELUS ecosystem, etc. It might be interesting to talk about a couple Horizon 3 areas that we're looking at that also will hopefully help inform the TELUS strategy going forward, but may be interesting to some people in terms of, hey, I didn't think that TELUS was looking at those areas or thinking about investing in them. The first one is Q Labs out of Australia. We led a co-investment in that cybersecurity company. it's got a unique aspect in that it focuses on quantum computing. So, back in the 80s, we had security protocols. It was determined that at that time that a computer would take, 1 trillion years to break these very specific security protocols for the telco networks, for security networks, for major infrastructure networks. But with the rise of quantum computing also comes the ability to crack those codes a little bit faster. So this company has got some really, unique kind of bleeding edge. They've done some unique bleeding edge work on quantum computing and how it impacts the cybersecurity world. And so, now we're looking at deploying some of those solutions in the next, number of years to make sure that our systems continue to be hardened as technology continues to kind of advance in those areas. The second one is, and just coincidentally, it's also a Q company, but it's Q Bio out of San Francisco. It's a company that really operates at the intersection of AI and physics and biology. The company is creating the next generation MRI machine. And with that machine, they're also leveraging AI to create a digital twin of, your body, and then can forecast for how it will age over time. It's really important now to remove some of the burden on the healthcare system by not just reactive medicine, but doing some proactive medicine. And so if your digital twin predicts some affliction potential in the future, you can start doing things today, like changing your diet, changing your exercise regimen, maybe addressing it with some sort of pharmaceutical at an earlier stage than letting it manifest itself into a later stage problem. So that's an area where we're trying to get ahead of, strain on the healthcare ecosystem by leveraging preventative medicine via AI.
So what is the, I guess, 2.0 MRI? Like, does it mean you don't need an appointment? Does it mean that, it'll be more easily accessible? I mean, MRI machines are, very expensive. I guess there's also, radio, or, you can't keep having them either. So essentially you need a photograph of yourself
Yeah.
internally to monitor in real time regularly to be preventative. Is that what this new version would be offering?
Yeah. So the idea is a little bit more like an airport scanner. When you go through that, you put your hands above your head or something like that, something that you could walk through. So that could be placed at, a shopping mall, right? And you can walk through the machine. The intent is to bring down the cost dramatically of the machine, of the MRI machine, to decrease the time it takes to go through the scan and to decrease the time it takes for the evaluation of the scan, right? There's different cost elements there. The machines today, yes, extremely expensive, but it's also the radiologist time in order to run the scan as well as to interpret the scan. It takes a lot of time. So QBio is looking at addressing both those cost pain points and making scans readily affordable, reducing the time it takes for the scan so that you can have repeated scans in a relatively short period of time and kind of create, more robust digital twin of yourself. So
yeah, I think that's kind of interesting. Like I've had private MRIs in other countries where the price point is so much lower than, even the private ones in Canada. So, I mean, I think that would be very, very interesting. I mean, they're more populous countries, so I suppose that could be a reason. But
yeah.
I think also not having to sit in a tube for like an hour, trying not to move, listening to that hum in sort of like a claustrophobic hole would be kind of nice if you could get the same outcome, but not have sort of the dreadful experience of it.
Yeah, I think if you increase the availability and then increase the user experience, right, it would be more widely adopted, and people would have greater access to it. So that it's it's a ways away in terms of its development, uh, but uh, um, but we think that there's some legs to that one.
Well, definitely. If it's just going to be like an airport scan, that would be fantastic.
Yeah.
So I'm going to just move on here to see if there's any questions. I think we don't have that many people online, but I will give them a few minutes here to try to
Yep.
queue up a question if there is somebody in there who does. So if you're listening and you're still on, this is your chance to ask a question.
And while we're waiting, I'll just talk about maybe the third one that I had on my list, which is a company out of Vancouver. It's called GenXys. They're in the pharmacogenetic space, which is looking at your genetic makeup and profile and the medications that you're assigned given whatever affliction that you might have, and looking at the drug interaction between those medications, but also about the efficacy of the dosage, the timing, the specific medication that ties into your genetic makeup. So typically, the first prescription isn't always the most effective in treating whatever symptom diagnosis you might have. It sometimes takes multiple rounds of experimentation with drugs, specifically at the more complicated medical procedures. And so this company is trying to look at your genetic makeup to say, the first time I'll be able to assess, okay, this is the appropriate drug for you based on your genetic makeup. This is the dosage that you should take. This is the time that you should take it. And based on the other healthcare factors that you've got, it significantly mitigates any negative drug interaction with other medications that you might be on.
Yeah, these last two that you've mentioned, I think are really cool. I think, we're kind of in the middle of this sort of real time healthcare data availability, soon coming to anybody near you.
Yeah.
But I think it'll be really interesting for, people probably within the next decade here of being able to track everything about their healthcare, their environmental interaction, and their genetics in real time over time. Because, a lot of times when you're getting, health care, they're not looking at maybe what happened when you were between 5 and 10. But that is a lost data point, or a data point that's not really looked at. But if you're looking at blood tests all across time,
Yeah.
I'm sure that has some sort of value.
Even that last company, GeneXus, just think about the value chain there and who it kind of
Yeah.
benefits. So, obviously from the patient point of view, you don't want to be taking a less effective medication and then having to switch. You want to take the right medication at the right time. So patient outcomes dramatically improved. Again, if you're not taking, or if you're reacting to the medication that you were first prescribed, you're probably going to have another doctor visit, right? And so if we can get the right medication to you in the right dosage at the right time, it avoids that second or third doctor's visit, which increases the access to healthcare for others in the system. And then at the back end, it's the insurance companies, right? The that industry, multi-billion-dollar industry, spent on maybe medications that were incorrect from the outset. They would rather, right? And it'll lower everyone's premiums, insurance premiums, if we're focused on the right medication at the right time at the right dosage, right? And so you can kind of see across the spectrum where something like a GeneXus product really benefits everyone, very little downside to that solution. We just need to kind of inculcate it in the broader medical stream.
Yeah,
So
no,
we're really excited about that one.
I definitely agree with you. I think our healthcare system is still very much trial and error, and I think that for any treatments you're getting, there's always some data point that's missing, and it's not always because of someone didn't check. Sometimes it's just not available because that's not the way that we do things.
Yeah.
So I think it's really exciting for technologies like the ones that you've mentioned there, at least from a patient perspective. So I don't see any questions in here. So before we wrap it up, or I should say, while we're wrapping it up, do you have anything you'd like people to follow if they are a startup and want to get in contact with you? Do you have a method for that you'd like to share with the audience?
Yeah, we're fairly active on LinkedIn. That's probably the best place to see what we're up to, where we're going to be across the globe with our team, as well as new announcements of investments. So go to the TGV LinkedIn site. Our impact vehicle, the TELUS Pollinator Fund for Good, also has its own LinkedIn site. So I'd encourage you to look at that. And then typically our website is the best point for entry. We do have sector and geographic representation, and so there's experts in each one of those areas, and so it depends on the area of focus. There'll be a person assigned to that. It's pretty obvious who they are from the website, but that would be great.
Yeah, great. Thanks for doing this, Martin. And the playback will be available on the Spotify and YouTube channels for Candid Capital. And the next live stream will be on the social media for anybody who's following, who wants to find out what's next. Thanks.
Thanks, Josh. Great to spend an hour with you.
You can find information about the Candid Capital podcast on the website, LinkedIn, and Twitter. Episodes can be found on Spotify and other podcast platforms. A quick reminder that this is infotainment and is not intended to be professional advice, malicious, or hateful. The views, information, or opinions expressed during the podcast are solely those of the individuals involved and do not represent those of employers, partners, and their subsequent connected private and public associations or organizations.
We candid, I hope you understand it. Your business growth, we planned it, yeah. This ain't for show, we stamped it, yeah. No FOMO, everyone come join, no solo. This all factual, from me to you, this Candid Capital.